Have you ever heard people talk about interest rates and wondered why they are so important? You often hear about them in the news, from banks, or even when friends discuss loans or savings. But what exactly is an interest rate? Why does it matter? And how does it affect everyday life? Let's break it down in simple terms. An interest rate is basically the cost of borrowing money, or the reward for saving money. Imagine you borrow $10 from a friend. If your friend asks you to pay back $11 later, that extra $1 is the interest. The percentage of interest compared to the money you borrowed is called the interest rate. In this example, borrowing $10 and paying back $1 extra means the interest rate is 10%. Banks and financial institutions work the same way. If you borrow money for a car, house, or business, you will need to pay it back with interest. That extra amount is how banks earn money and cover the risk of lending. On the other hand, if you put money into a savings account, the bank pays you interest as a reward for letting them use your money. Why are interest rates so important? Because they influence how people spend, save, and borrow. When interest rates are low, borrowing money is cheaper. This often encourages people to take loans for houses, cars, or businesses. It can also push businesses to expand because the cost of borrowing is affordable. However, low rates also mean people earn less from their savings. When interest rates are high, borrowing becomes more expensive. People may think twice before taking loans, and businesses may hold off on expanding. But savers benefit because the money they keep in the bank grows faster. Interest rates are not random. In most countries, the central bank, which manages the nation's money system, decides the base interest rate. They raise or lower it depending on what is happening in the economy. If inflation is too high, meaning prices are rising too quickly, central banks may increase interest rates to slow down spending. If the economy is weak and people are not spending enough, they may lower interest rates to encourage borrowing and boost growth. So how does this affect your daily life? If rates go up, loans for homes, cars, or credit cards become more costly, but savings accounts may give you more returns. If rates go down, it is easier to borrow money, but you earn less from saving. To sum it all up, an interest rate is simply the price of borrowing money or the reward for saving it. Low rates make borrowing cheap, but saving less attractive. High rates make borrowing expensive, but saving more rewarding. Understanding interest rates helps you make smarter choices about loans, savings, and investments. Thanks for watching. And if you found this breakdown helpful, remember to like, share, and subscribe for more simple explanations of big economic ideas.